grow it organically. They'll improve margins. They'll work and do an M&A strategy, a buy and build strategy. Let's buy a bunch of companies in the industry that are small and they're cheap and put them together, and build something big and special that trades for a much higher multiple. We'll create arbitrage, which is the one way private equity makes the majority of its returns.
Welcome to Top M&A Entrepreneurs. Today, my guest and having back for the third time is Adam Coffey, author of these books. Do you have them? Private Equity Playbook, The Exit Private Equity, and The Empire Builder. You got to have these books. And I'm having Adam on today to talk about the re-release of the 2019 book, Private Equity Playbook. Bestseller.
John, first of all, good to see you. Good to be back 3 times. Third time's a charm. I don't know if you've had other third-time guests, but I'm gonna have to bring it this time to make sure that if when book 4 comes out, next time the total new book next year, it's like you'll have me back again. So.
Yeah. Holly tells me you do a lot of the writing on these books, which is I am thoroughly amazed about how well it is easily to understand and read these books. It's just fantastic.
So Empire Builder, good classic example. And all of my books started as lectures. They started, so whether it was a college lecture or it was a seminar, Empire Builder was like a 500 slide PowerPoint deck, 2-day seminar. And as soon as so I perfected the material, taught the seminar. As soon as the seminar was done, then it's like, okay, time to write the book, Empire Builder. And, JT Fox, friend, business partner, he says, you're the only guy I know who goes from a seminar where you're charging like $3,000 per attendee and then converts it to a $15 book. And I'm like, but JT, 1 million people buy that book and only 1,000 people come to the seminar. So, there is some rationale behind that. But
I was watching a comedy movie the other night where it goes, the actual president goes, yeah, I'm going to go into movies. I don't think anybody's ever made that transition.
Yeah, I hear you.
Yeah.
So, it was time. So the whole story behind this was, I actually wrote the Private Equity Playbook in 2018. And did the research, mid-year, kind of, it finished the book by the end of the year. It came out in early 2019, but that's been 5 years plus ago, and so much has happened in the world, including pandemics and things like that. And so it decided it was time. The Private Equity Playbook still hits number 1. It's never fallen out of the top 10. It's been number 1. It was number 1, a few days last week. It's like that book has just got a cult.
Yeah, it's crazy because you post on LinkedIn. By the way, follow him on LinkedIn, and you will see some posts like he'll have the top 3 books in that category pictured side by side on Amazon.
Yeah. So it felt like I need to refresh this. To keep this book fresh for another 5 years, so the second edition, it's not an entirely new book, right? So I wanted to keep true to the original manuscript, but we did add, expanded content, updated all the numbers and what have you. But, it felt like it was time. It's been kind of the go-to book for people to learn about private equity for 5 years. And I wanted to make sure that it stayed relevant. And it stayed fresh. So,
So let's talk about that. What's the big differences between the book that you wrote here that's still relevant today and what's in the new one? Your assistant sent me the manuscript, so I've got it.
Imagine this. So I'm writing, I'm doing my research. I'm writing the book. It's 2018, when I wrote the first edition. There is $2.83 trillion in assets under management in the world of private equity. And if I remember right, there's like 5,300 firms or something like that. Roll tape forward 5 years, there's over $6 trillion in assets under management. And there's over 8,000 firms. So the world of private equity has doubled in the last 5 years alone. And we had the pandemic, and now we know what essential businesses are. And so, it was fun to go back through that book, and it's like I felt like I had Marty McFly moments. So it was my first book, but now that I'm updating it, I'm mentioning things that happened in book 2, 3, and 4, and I'm like, well, wait a minute. It's like, how could I possibly know about my future books while I'm rewriting the first book? And so I felt like I was in the movie Back to the Future, and I even wrote it in there. I'm having a Marty McFly moment because.
By the way, I love that 3 episodes of Marty McFly. Yeah.
So really, it was about just updating the fact that private equity, at this point now, private equity buys and sells 50% of all companies bought and sold on the planet, and that wasn't the case back in 2018. So we finally hit that threshold where now half of all M&A activity on the planet is private equity. So
yeah.
And I think for entrepreneurs, right, it's because of that explosive growth and the underlying fact that capital must be invested, that's inside a private equity fund, that we've created a market where an entrepreneur can build a business and sell it and make a ton of money. Before private equity, really it was, there was a small market for people to sell a company, very small prices paid. And you were looking for an owner operator, someone who would kind of take over your business when it was time for you to retire, or on a rare occasion, a strategic would gobble you up. And so it's because of private equity that this whole market's been created. But still to this day, believe it or not, if I teach a seminar and I have 1,000 entrepreneurs and business owners sitting in a room, these are smart people. They've grown up now in the world of private equity, and I give them a basic 10-question quiz, that's multiple choice. 90% of the room still fails. And so I feel like the original reason I wrote that book was to try to educate a generation of entrepreneurs about what private equity is, how it operates, how it can become a tool for them as a part of their wealth creation journey. And I still feel to this day like it's unfinished business. And I've had 2 people now. I've been doing this same 10-question quiz for years, and I've only had 2 people on the planet in thousands and thousands of people, probably tens of thousands of people that I've given the quiz to. Only 2 people scored 10 out of 10. They both read my book, like heading into the seminar, and they had eidetic memories, and all the answers were contained in the book. But still, 90% of the room will fail miserably, which means entrepreneurs have heard the word, but they still don't have a basic understanding of what private equity is and how it works. And we need to understand this in order to, don't tell any private equity firms I said this, in order to manipulate that capital as an entrepreneur to take from it what we want, which is growth capital and wealth. We have to feed it what it needs. But in order to understand kind of the nuances of how the game is played, we need to have a basic understanding of what the hell it is and how it works.
So yeah, let's ask about that. What is private equity? For nobody's ever seen this show, what is it? Why should we get into this arena?
Well, so if you think about a mutual fund, a mutual fund manager, I can go on my Schwab account, I can buy a mutual fund, I can research, look up Morningstar ratings, what have you. A mutual fund aggregates money from a bunch of people, and the manager then decides what stocks to buy, puts them in a basket. I have instant liquidity. I can buy it today, sell it tonight, sell it tomorrow. I can hold it for 5 years, whatever I want to do. Instant liquidity, it's publicly traded. A private equity firm raises a fund, and on average, it's I'm gonna leave family offices out right now and venture capital out. And I'm just going to talk about buyout funds because that's where the majority of capital is in private equity invested today. So a 10-year fund is created, and limited partners or investors commit $5 million or more as an investor, to this thing called a private equity fund. The fund exists for 10 years. It doesn't take your money up front. And let me tell you the secret of why. Because if they took your money
from investors up front.
Yes, they don't take the money from investors up front, because if they did, they'd have to start calculating returns based on the day they got the money. So
right.
They're very shrewd and smart about that. So you keep your money, you just commit. I'm going to give you $5 million, and for the next 5 years, they're going to look for companies to buy. And when they find one, they're going to send you a message and they're going to call capital, which is your percent of the fund that's required for them to purchase the company. So they'll call money from me for 5 years, up to 5 years. Once they own a company, that becomes a platform. And they have then, on average, most hold periods around 5 years. So for about 5 years, they'll work with that company. They'll grow it. They'll grow it organically. They'll improve margins. They'll work and do an M&A strategy, a buy and build strategy. Let's buy a bunch of companies in the industry that are small and they're cheap and put them together, and build something big and special that trades for a much higher multiple. We'll create arbitrage, which is the one way private equity makes the majority of its returns. And so, I've got then by the end of the 10th year, I have to return all of the money back to my investors. So I have to sell all the companies. I have 5 years to buy money, to buy companies. And I hold them for on average about 5 years. But in that 10-year lifespan, I buy, I improve, I sell, and return all capital back to the investors. And so interestingly enough, let's talk for a minute about buy and build, because that's the one strategy that I've kind of dedicated the last 10 years of my career. So I just turned 60, and I've told myself, rather than build a fourth company for a bunch of private equity firms, I am going to teach as many entrepreneurs in this world how to succeed by emulating the activities of private equity, but do it on a smaller scale. And so in the United States, we got 34 million small companies just here in this country. And small, talking now, small to the government is different than what you and I think is small. Small to government is 500 employees or less. And that represents 99.9% of all companies in the United States. And, it employs more than 50% of the workers in the United States. So 34 million small companies. But globally, there's only 3,000 companies on the planet that have $1 billion in revenue. And so because there's 34 million small, there's not enough buyers. Even in the world of private equity, there's not enough buyers to buy all those companies, so prices stay low. And so if we can buy a bunch of small companies and put them together, we become bigger. We get over the pack of the 34 million small companies. We are now rare, and larger PE funds can now put a bigger chunk of money to work, and they can buy us, but they have to pay a much higher price because there's not as many bigger companies that are out there. And so this natural occurrence of small companies trading for small multiples being put together to grow bigger and then sell for a higher multiple creates the profit that private equity uses to generate. Right now, John, I'm working on 18 buy and builds.
18 buy and builds.
I have 18 buy and builds going on right now where we're buying small companies and fragmented industries. We're putting them together and we're creating a meal to throw up and serve up to the private equity firms that are looking for stuff to buy. Now, we're only buying good companies and we're also growing them organically, improving their margins. We're building good companies. But what we're doing is we're emulating what private equity does on a large scale, and we're doing it on a small scale to kind of feed companies up to the smaller echelons of private equity who are looking for platform companies to buy with their fund. And interestingly enough, all PE funds kind of act the same way. So regardless of whether it's a Blackstone fund that's 10 billion to 30 billion in size, or KKR, or it's a really small PE firm with less than 100 million in their fund, they all invest about 6 to 8% of their fund size into any one company. And they never invest more than 12%. They do this for asset diversification rules that they build into their charter or their prospectus. And so average PE fund's going to own anywhere from 8 to 16 companies. And so if you're KKR and you got a $30 billion fund, 6 to 8% of your fund to buy a company, that's a big number. And so they can't go down and buy companies in this pool of 34 million.
They're buying in the 3,000.
Because it would take them 100 years to put that 30 billion to work. So they buy bigger companies, bigger firms, bigger funds, buy bigger companies. And it's created these different tiers. I call it the private equity pyramid.
Can I show everybody this model? Because this is fantastic. I share this all the time and I give you attribution, but this is the private equity pyramid. Follow him. He's going to share this. And I also
So
share
there's
this
an
too.
example,
Yeah.
like in this book, in the new version of the private equity playbook, I hadn't like coalesced the private equity pyramid in my head back in 2018 when I was writing the first one. So you'll find now the explanation of the PE pyramid. It's a part of the story, of private equity. Part of explaining private equity is explaining how a fund is put together, how long it lasts, how it invests its capital, and how it generates its wealth and generates its returns. And then it teaches us as entrepreneurs how that works so that we can kind of manipulate's a strong word, but manipulate it to our advantage to take what we need, which is capital to grow, and then wealth. We want to create wealth for ourselves, and to do that, we have to make their investors, their limited partners, we have to generate returns. So the private equity firms are capital. They're the checkbook, but they're not operators of companies. So they need us to be the company operator that grows the business and gets the returns for their shareholders. So it's the perfect marriage of entrepreneur with unlimited wallet can grow business much faster, both organically and inorganically, by buying companies and putting them together.
Let me ask you a question about. I want to get something clear on something. So you create an investment thesis and say, I'm going to roll up HVAC companies. This is my buy box. Simultaneously, you're knocking on the door to investors to get commitments. They're not depositing funds in the account, but we'll commit $5 million to this fund, and they'll write you a term sheet. Where does it come in that do you bring deals to them and they can veto them? Because not all deals are a royal flush. They're missing something, and usually capital or traction or story or team, which you are, and that's capital that they have a say in what, like, okay, we're going to sign and approve this term sheet with you.
Well, you know what? There's multiple ways this can be done. When starting out, so I'm on the board of a company, and it was two young guys, very smart young guys. I can call anybody young because I'm 60 now. So these guys are in their 30s, right? But they had backgrounds in investment banking and in private equity in more junior roles, not senior roles. And they put together like a 6-month, they did a 6-month research project, created an investment thesis, get some old guys like me who've got some experience around the hoop, and then they go shop it. They go walk into a family office and they walk out with like $100 million commitment. So now we've got a roadmap, we've got capital. Now we go look for the platform, and then we start buying companies to add on to that. So that's called thesis-based investing. So as an entrepreneur, we can create that thesis, and then we can shop the thesis looking for capital. That's one way to do it. More frequently, though, a private equity firm will be they've done a thesis about an industry that they want to invest in, and they'll go out looking for a platform company. And so the people who are out looking for a platform company, these are the phone calls that you're getting as an entrepreneur. It's like, I've built a business, I'm successful, and now it's like people are calling because they're interested in buying my company and having me partner with them. I'm going to be the platform, and now they're going to work with me to accelerate the growth and start doing this M&A process, this buy and build story. So a good example is my last company. The platform itself was bought by a PE firm, and they paid around $125 million for it. And it was like half of that was equity, half of that was debt. And once they buy the platform, then it's like, we need a CEO. We need somebody to come in and turn around this dog with fleas and fix this thing. Hey, let's go get Adam. Adam comes in. I'm the CEO, and so I start first by turning the company around that I've got. But then over the next 5 years, we buy 23 companies. And we bolt those 23 companies on top of this thing and build a really big company. And less than 3 years in, after buying the first 8, we sold it the first time. And for investors, it was a 4 times multiple of invested capital. So for every dollar they invested, they got $4 back. It's a massive IRR when you pull that off in 3 years. It's 50+% IRR. So for all you real estate investors out there, it's like, that's a big number, big return. And, this is how it's done. So as entrepreneurs of small businesses, we get a lot of calls from buy-side advisors or people who are out looking for add-on acquisitions that strategic companies or bigger companies want to buy. Maybe they're backed by private equity and they're looking to do add-on acquisitions. And so like when I was running the HVAC company, I'm running a strategic platform. I'm running a couple $100 million HVAC company, and then I buy 23 smaller companies and I add it on top of the pile. So I'm a strategic backed by private equity out looking for add-on acquisitions. And so my buy-side advisors, my M&A teams, they're calling all these people that own small HVAC companies, and small business owners, small and medium sized business owners. We're getting calls all the time, every day. Most of your listeners to this podcast, if they're a business owner, their phone rings all the time.
Yep.
I'm a buy-side advisor. I'm working on behalf of a private equity firm that's looking to buy, want to make you a platform. Boy, you're a sexy looking company. We'll pay you more money than you've ever seen before. Talk to me, and then when you hang up that call, the next call, comes in. I'm representing another private equity firm and I'm going to be the best partner ever. And I'm going to pay you more money than you've ever seen. It's like, there's so many calls going on right now. And so it because they're buying more than 50% of the companies on the planet, because they've created the market, even if we intend to continue to stay independent, we need to understand how private equity works. But we definitely need to understand how it works so that we can understand the conversation that we're about to get into as a business owner. We could be sold as an add-on to a bigger company. We could be sold as a platform to a smaller PE firm who decides to take us, make it an anchor holding of the fund, and now we're going to seek to grow that business over the next 5 years. Cool part is because the average hold period is 5 years in private equity, if we're an entrepreneur, that means we're going to get a payday about every 5 years. So I sell my company to private equity, I get a payday. I roll over some money. Most entrepreneurs think I sell my company, I'm done. An exit is the end. And boy, I've bought 58 companies, and let me tell you, the exit's the beginning. It's not the end. If you think it's the end, then a guy like me swoops in, and then I get 3 more paydays, that you could have participated in. And so rollover investing in multiple bites of the apple is a big part of understanding how private equity works. Because what's better than selling your company once, selling it 2, 3, 4, or my personal record 5 times? And we can get paid along the way. And because private equity on average holds every 5 years, if I'm talking a 10-year period, I could sell my company, payday number 1, 5 years later, sell it, payday number 2, and then 5 years later, sell it again, and 3 paydays in 10 years. Each payday, if I played my cards right, bigger than the one previous, where I thought it was a one and done exit event, I get like 3 checks, and each one's bigger than the last, and I'm making massive amounts of money. I'm creating true generational wealth for my family. So I tell entrepreneurs, don't think of selling your company like it's the end of the road or one and done, unless you're in your 70s and you're just wanting to go fishing the rest of your life. You can actually use private equity as a tool, and you could be in your 30s or 40s. I have a new client. One of my clients the kid is 33 years old. He's built a company that literally has gone from 0 to almost $100 million in size in 5 years.
That's impressive.
Got 25 million of EBITDA, and I'm like, and he wants to monetize it. Now I'm like, dude, we are going to have a lot of fun. You are going to be wealthy beyond all of.
And your recommendation to him is, this is the platform company. Let's go buy other.
This is a platform company. Let's de-risk and get some of your chips off the table. So let's say this company sells for $250. Let's take, 30%, 75 million, roll it forward, and you keep on. You're only 33. Where the hell are you going? Keep running this thing that you built, but now using other people's money, as the fuel, the jet fuel. So we'll roll over, 75 million. We'll take the rest home. So 175 million home. You'll pay your taxes. You'll diversify. You'll invest elsewhere. Now roll tape forward. If we can do that typical PE return, my career average is better than 4X. If we get 4X on that 75 million, well, that's now what? 290 million. Well, that's bigger than the original 250 million. And we're talking like in a 5-year period, this dude's now worth $500 million, and so we can do great things. And I know for entrepreneurs, a lot of people get stressed. Hey, look, I've never had a boss before. I don't know if I can handle that. And I not only that, but if I'm not the controlling shareholder, I don't know that I want to be involved. It's like, I'm God's gift. Why the hell would I want to have a boss and be a minority shareholder? And I usually answer that, by mentioning two names. I say Elon Musk and Jeff Bezos, two of the richest guys on the planet who both collectively own less than 13% of their companies. It's like, you can be a minority shareholder and you can make a lot of money, along the way too. So don't think of selling a company as one and done. Think about it as this wealth creation, wealth generation tool that you've developed and you've grown, and why not get that thing to pay off multiple times rather than one?
Yeah, this 30-ish-year-old guy, he's the platform company. Does it make any sense? Because I'm kind of helping with deal flow with a company. It's a brand new private equity company, but they're helping in unrelated industries. Like, hey, we're going to look for e-commerce and 2 million, but if I buy something in mobility scooters, or then go over here to food, blog or something like that, those are completely unrelated. That part of that seems like it doesn't make sense because you're not going to grow the wealth as a fund.
Yeah. So, but you have funds. So, first of all, if we're talking about a company bolting on these weird things that don't really fit together, to me, that spells disaster. If I'm a PE firm, some firms are called generalists and some are specialists. And so bigger firms will have multiple silos. They'll say, hey, I'm the services silo. The group of professionals that work in this area are focused on, kind of industrial services, residential services, we do services. And then there's another division, kind of the PE firm. Well, we have a healthcare fund and we're investing in healthcare and healthcare technologies. And then, so it's like there's different subsets, but some firms, generate funds, and those funds are generalist funds. And so they invest all across the map. And so by buying, call it on average, 6 to 16 companies with one fund, they may own in several different industries. And so they've got broad diversification, and that's not necessarily a bad thing. Think of it like this. You could have an S&P 500 fund, stock market fund, mutual fund.
It's diversified. Yeah.
That does the whole diversified basket. Or you could do, S&P 500, but it's only high dividend paying, or it's only growth stocks, or mature, or tech stocks, or, whatever. It's like, so some firms specialize, some are generalists, and, it's proven that there's room for all.
Yeah. These 18, let me go back to your 30-ish-year-old guy with $100 million, 25 EBITDA. You're going to start adding on acquisitions to get it to what?
He's done all of this organically. We're going to prepare this company for sale. And I'll tell you that, from an entrepreneurial perspective, just because someone calls you up doesn't mean that they're the right buyer. Just because someone calls you up, you don't push print on your financial statements and assume that they're prepared for a buyer's scrutiny. There's a lot of pre-work to do, in getting a company ready to go to market. But what we're going to do in this case is we're going to take the company to market in 6 months. So within a year, young man gets first payday. We're now going to be a platform for a large PE firm because at the size we're at, we're going to attract some very large PE firms. And it's a services business, a lot of recurrent revenue. It's like it's going to do really well. And then, so he's got a first payday, still there, still running it, but now owned by a PE firm. Now the PE firm looks at that really strong organic growth rate and says, okay, keep on doing that, guys, but let's now also start an M&A engine going within this business so that we can amplify growth even faster.
By the way, that is written out in this book right here, Empire Builder.
Yeah. You know what? To be honest with you, it's like Empire Builder was my favorite book.
Yeah.
This is my favorite rewrite because it's the only rewrite. But Empire Builder was my favorite first book. Third one, you start to get better. And I these other ones have been kind of subject matter expert books. Empire Builder is the roadmap. If you want the modern equivalent of a treasure map, for me, that's Empire Builder. You're a young entrepreneur just starting out. It's like, Empire Builder is the roadmap to making and creating wealth, for you and your family. So, this guy will become a platform. They'll add an M&A component to it. We'll look to make some strategic pivots because we've got a great customer base. What else can we sell them? So we'll be looking for strategic pivots. We'll be buying companies that are in his industry, and we'll keep on growing this thing even faster so that we can, when we sell it, we get a really high multiple and a great exit.
And you go along for the ride, right? Not only just a consultant, but Equity Plateau.
So it depends on. I have all permeations. I'm invested in several. I coach and mentor the CEOs. And help them with the transition to private capital. I'm hired by private equity firms to then sit and help and continue to coach and help them kind of through the PE journey. So I kind of ride shotgun on a lot of these adventures, and I where I like the company, I like the industry. I'll make co-investments alongside as well, and and it's fun.
What about that? Let me ask about the 18 different. Are they all different, or are they some like, hey, I got 2 or 3 in the landscape in different sections of the country?
No, there's some repetition in there. So when I like an industry, I'm not afraid to invest in 2 or 3 platforms within a given industry. Generally geographically spread apart. So I'm not, I'm not, in competition with myself. So when I'm doing this with smaller entrepreneurs, they're generally, a localized company in a state or a region. So if I've got somebody going in the Southeast, and in a given industry, bookkeeping, accounting, in the Southeast, well, I can do one of those in the Northeast. I can do one of those in the West, kind of thing. So when
I want to ask you about that. Brad Jacobs got a book out, that Billion book, and he's got a chapter on there. He passed on accounting firms. So my little bird tells me that you're working on an accounting firm roll up with maybe JT Fox. And why do you like accounting firms? Why did Brad Jacobs just like, no, we think AI is going to be destructive in that industry?
Yeah, well, good for him. So that's the beauty of this world, is that we can all have our different opinions. So from Empire Builder, if you read Empire Builder, why do I like accounting and bookkeeping? Well, number one, it's a need, not a want. Number two, it's recurrent contracted revenue. So I'm not talking about firms that specialize only in tax or have massive revenue in tax. I'm talking about your bookkeeping and accounting and payroll firm that helps small business keep their books in order. And so I've got a monthly recurrent revenue stream. Because I am doing the books, that leads me to payroll. Because I'm doing books and payroll, that leads to doing the company's tax work. Because I'm doing the company's tax work, that leads to me doing the entrepreneur's tax work. So these are all interrelated kind of specialties. And there's no capital expenditure to speak of. So I don't have any plants, trucks, equipment.
Well, the EBITDA net income is amazing. It's just 50%.
So right now in the United States, there's 1.8 million bookkeeping, accounting, and payroll service companies in the U.S. So it's highly fragmented. I can buy a bookkeeping company that's got 3 million in revenue and almost $1 million in free cash flow and pay 3 times for it. And that business, is like, is just a cash generating machine. So I've got not only enough cash in the business to service the debt that's required to buy it, but I'm also distributing money to myself, along the adventure. I buy some of these and put them together, and I start to get that arbitrage, effect. And so
where's the arbitrage with the accounting firm? What does it need? What the EBITDA need to be for that?
Well, so your 2 natural exit points, I call it, my first window to exit a business is about 4 to 7 million in EBITDA. And so if I buy 4 accounting firms, and I pay 3 times, and let's say I bought 4 accounting firms, around $1 million each in EBITDA, and I'm paying 3.5 times for these, and I'm gonna get the synergies out of them. I'm gonna increase organic growth. And so what I'm actually going to sell is 5 million worth of EBITDA, and I'm probably going to get around 7, 8, 9 times, depending on the makeup of the firm, where it's at, the clientele. There's variations, but let's just say I get 8 times. So I paid 3 times to buy them. So for every $1 of EBITDA I buy and pay $3 for, I then turn around and sell it for 8. pay back the $3 I borrowed and put $5 in my pocket. And so every time I build a model, on an accounting firm. So I'm doing one where we're headed for kind of 4 to 7 million exit. I've got another where we're going to 10 million, in EBITDA. Then the numbers get even more compelling. Just takes a little longer to get there. But so I like them because it's recurrent revenue, contracted revenue. It's a need, not want. It's a professional services company, very high margin, almost no capital expenditure. I got to buy a few Dell computers, right? And most of these companies have back offices in India, and so the cost, cost structure.
Yeah.
And so
GAAP accounting can be done anywhere.
Attractive.
Yeah.
So all I could say is maybe what he didn't like. We don't buy firms that do audit work because audit work.
There's a wall. Yes.
Yeah,
there's
so
a separate.
That firm must be owned by a CPA, and if I'm selling to private equity, they're not a CPA. There's functional workarounds, but it's clunky. So there are I'm focused on bookkeeping, payroll, tax. And tax is not the primary driver; it's ancillary because of the businesses and the work that
has to be done. Yeah. And there's really not a lot of requirements as far as training to be a EA agent. Yeah.
So I'm currently participating in 3 roll-ups in that space.
3 roll-ups in that space.
3 roll-ups in that space. I love professional services. I love blue-collar services. I love services, kind of period. It's like services is my bag because they're all low capital expenditure for the most part. They're all, and then, they have different attributes to them. Like the last company I built was a large HVAC and commercial refrigeration service company. And so it's a need, not a want, but it's not necessarily contracted revenue. There's a lot
like plumbing, it's a need, but it's you still got to get a new customer all the time.
Yeah, and so the for your listeners out there, it's like, let's say I own an HVAC company that's doing residential HVAC. You buy a new system from me this month. You're not buying a new one from me next month. So that means that every month I start with 0 revenue, and I'm looking for enough customers to replace the revenue that I created last month. And then I have to have 1 extra system sold in order to show growth. So it's not as recurrent as I'd like. So recurrent, I like pest control. I like landscape maintenance. I like businesses where I sign a contract, and every month I am hitting that customer's credit card. And now when I find a new customer, it's adding on top of the pile of old customers I had. So this could be janitorial services. It could be,
not roofing.
Yeah. I'm involved with 7 roofing companies. Roofing is really hot right now in the private equity space. But here again,
but that's not reoccurring though. It's like every 14 years or 15 years.
So here's what they'll tell you. It's not recurrent. It's not contracted, but there is a recurring nature. So here's the nature. If I'm in a town with 1 million homes, then a certain percentage of homes every year is going to need a roof replacement.
Gotcha. A long-term view.
Yeah. And so if an average, roof lasts for 15 years, then what is that? That's 8%, whatever the number is. There's a certain percentage of roofs in a metropolitan area that will get replaced every year. So there's an opportunity to serve, every year, and I just have to go get my portion of it. So companies that are like that have banker representation, that are big, that are selling from one private equity firm up to another, or founder led to a PE firm, we're calling that recurring. There is a recurring aspect. There's a need, and the need will always be there. But it's not like a pest control company where it's just a contract. And so on HVAC, we did a lot of service work, but the service work is pretty much time and materials. So I would start the first of the month and not know where 80% of my revenue is going to come from for the month, which means I can have.
It's a big nut to cover that stresses you out.
Yes, it does. It does. And so I'm getting old. I don't want stress. So I focus on companies that have contracted revenue streams now almost exclusively. But I am doing roofing because roofing's hot. And just like HVAC, I can get in, I can get the job done, I can make money, and do well, and so
Let me ask you about how, when you get a client and you say, okay, you're the platform company, let's go start building, and how you buy those. What do you use for the cap stack or recommendation? And I'll give you an example. I did a podcast with Brian Pierce. He started out with 4 Midas shops.
Yep.
Now he's got, I think, over 35 doing $40 million. And he uses 100% seller financing because his balance sheet now, he's the bank.
Yeah.
He's so much stronger and can have that negotiating leverage.
So I love where we're going with this. So I call them avatars. So if I'm going to go into an industry and I'm looking to do a roll-up, and I'm looking for that first company, the platform company, I'm going to create an avatar. The avatar is, what does my perfect business look like? What's the revenue? What's the earnings? What's the age of the person that owns it? So if I'm passive and I'm an investor and I'm going to help from a board perspective, I need a stud or studette. I need a rock star that has enough runway left so that when I want to get out and sell it, that the PE firm, it sees the future potential of that leadership team. So my first platform, my first company, which is going to serve as my platform, I need a leader that has a future, that has legs, that can stay with the business for at least a good 10 years. So my profile is different for that person. I'm going to let them roll over, probably 30% of their sale price, because I want them to have an opportunity to make a ton of money alongside me. So I have a model on my desk, my first platform company, person rolls over about 300 grand. They make 5 million, when I get out. And I don't show them what I'm making. I'm the bank, but I do show them what they're going to make, and it's significant. So, but then my profile changes, the avatar changes. So now I've got my leader. I've got a little bit bigger company that's got good process, good procedure. That's my anchor. That's my platform. Now my avatar changes. Now I'm looking for 60 to 70-year-olds who want to retire. And those people aren't necessarily, first of all, I probably don't have to pay high end of fair market value, and they don't really need the big chunk of money. So now
they don't have any more gas in the tank. Yeah.
They want to clip a coupon. And so now I turn to heavy seller financing. So I'll come back to how I pay for the first one. But the heavy seller financing on the next one, my avatar is now 60, 70, wants to retire, looking for the exit path. I pay them fair market value, maybe even low of fair market value, and they'll get some cash at close for sure. But now they're going to get, call it a 10-year income stream at a decent interest rate with a decent amount of their money. And so for them, it's like, okay, I'm 70, I want to retire. This person's going to let me clip a coupon, for the next 10 years. And if they default, I take my company back, so it's like, it's low risk and I'll sell it again, but it's they now have an ability to generate income over time while they're in retirement, which is what a lot of people
I think there's more tax advantages that way too versus the capital.
So I think people, people can do this differently. But when I look at a company that meets my criteria from Empire Builder, then, essentially what I've got is a lot of free cash flow. So let's say, for example, I buy that bookkeeping company and it's $3 million, and I'm paying $3 million for it. It's $3 million revenue, $1 million in earnings, and I'm paying $3 million for it. So 3 times. Okay. If I fully amortized and I bought 100% of that business and just wanted to finance it at 10% interest, $3 million is going to cost me $300,000 a year. If I'm going to also fully amortize it and start paying principal and what have you over a 10-year period, I need about $475, somewhere around that neighborhood to make those payments. And I've got $1 million in free cash flow. I've got a 2-to-1 debt service coverage ratio. So in the world of SBA, we could have the owner roll over 19%, and they don't have to sign on the loan. They can be a rollover investor up to 19% without signing on the loan. And so I now have 19% equity because I'm buying 100% of the company. I have a holding company. I'm putting the assets up into my holding company, and they're now, the person who owns it becomes my rollover co-investor, but as a minority shareholder, and they're bringing 19% equity. And maybe they're giving me 30% seller financing because they're also going to clip a coupon. And so now I've already got half the deals paid for. And so now I have to swoop in, and the banks want to see something from me. And so generally speaking, when I'm engineering this, if I'm going to put equity in, the equity is going to come in the first company, maybe the first couple of companies. But if I buy 7, my checkbook's been put away after the second or third company, and the amount of money I put in goes down very quickly because now I have equity. Now I have a business. Now when I buying the second business and third business and fourth business is so much easier than buying the first.
Yeah.
Especially if you're passive, especially if you don't have a track record. I mean, finding the unicorn. If you're passive, don't have any money, I need a business with high free cash flow so it can service the debt. And even with a great debt service coverage ratio and enough cash flow in the business to more than double cover the debt, the banks still want to see some kind of, can you give me 50 grand? Can you put 100 grand into it? I would tell you that I don't believe you have to come up with 20%. I already got 20%. That's the rollover equity of the seller, who's now my partner. But having some money certainly helps, makes it easier. But I'm involved in deals. Hey, I bought 23 HVAC companies. I didn't use a penny of equity.
Yeah. Well, you're talking about service companies where it's the EBITDA is 20, 25%, and then all the way up to accounting where it's 50. And I had a friend that just sold her accounting firm to a private equity. She had a 75% earnings. She was amazing. She put systems and processes in place, just in charge more.
And that's why in Empire Builder, when I'm talking about what kind of companies to buy, what I'm really doing is I'm trying to stack the deck in your favor as an entrepreneur so that you have a higher likelihood of success. And so the kinds of companies that I'm focusing on are generating enough cash to cover the debt that's required to buy them, so that while I'm collecting companies, I can use the cash flow that I bought to service all that debt. And I have a high enough coverage ratio to where even if the economy went down, if I've got a 2-to-1 debt coverage ratio, I've got $1 million in cash and I need $500,000 to service the debt. I could lose customers and revenue, and I've got to lose quite a bit before I'm coming out of pocket to cover the debt. And so that's different than I buy a company that has high, that's project-based, it's cyclical, and it's got high CapEx, and I got no real cash flow. That's where I can get into trouble.
Yeah, and I might bring that. I know that buying a business SMB and then using SBA, but when you only have a 1.25 debt service coverage ratio, there's just not enough left over to do any of that expansion or new equipment or.
And so that's why I happen to, we were talking about bookkeeping. Why would one person say no and another person say yes? Well, the reason I say yes is because it meets all of my criteria, and it's very high free cash flow conversion, and they're selling for very low multiples because there's so many of them, and they're mostly owned by older people, who want to retire, So I can collect them fairly cheap, put them together, and again, the odd part is there might be 1.8 million of them, but there's not a lot of big ones. There's mostly, I got the supersized ones, right, like the Deloittes of the world, but there's a ton of small ones, and there's not a lot of little medium-sized ones for smaller PE firms to come swoop in and take, because for them the arbitrage would be fabulous if they could find a platform at 10 million of EBITDA. The arbitrage would be fabulous because they can buy all day long, at 3 times the small ones and bolt them on. The problem is they only have 5 years to work, and they need to find something that's got critical mass, and there's a gap. So I've got big ones and we've got really small ones. We don't have a lot of medium-sized ones. So I saw opportunity, in that space, and I love the multiples that they're trading for. And when they're bigger, the multiples they're trading for when they're bigger. And, the arbitrage is great. The risk is low. The cash flow is really high. So it's, to me, it wasn't an attractive space, but I get people.
Yeah, it's a different opinion. Let me ask you just about the supply and demand. There's a good conversation on X about SMB. Some guy put his HVAC business on the market, doing well in Florida, taking off, and he had over 500 offers. Yeah. And I'm seeing this with Poe advertising because I'm on their email list, and they'll cut it off to the number of buyers wanting to see the sim. It's just it's amazing.
Yeah. Broad processes are pretty rare in today's world. When we're selling a company, typically, it's 30 buyers are kind of led into a process, and that's it. At some level, 500 is just too much to
Too
manage.
much. It's
Yeah,
just waste of time. Yeah.
yeah.
What? Tell me a little bit about the EBITDA. Why that is so. Everything you read from Warren Buffett, Charlie Munger, rest in peace, is that they hate the EBITDA number. Why is that so big and important into private equity?
Well, so we need some kind of a level playing field where we can value a company. And so EBITDA is an arbitrary line. Matter of fact, QuickBooks doesn't even have it. So if you're a QuickBooks company and you're looking for your EBITDA line, it's
It's
kind of
not.
like
It's net
looking for
income. It's
it's
net
kind of
income.
like
Yeah.
looking for a cable stretcher, when I was in the military, or you're on a snipe hunt, out in the woods looking for snipes. It's a nebulous place, but it's a place that levels a playing field. So let me give you two profiles. Let's say I have two companies, and they each have 4 million in revenue and 1 million in EBITDA. And one company has not been investing for its future. And so they have deferred maintenance. They got a bunch of trucks out there, and their average age of their trucks is 10 years. And so they've got deferred maintenance, but they're showing $1 million in EBITDA. Another company might have $1 million in EBITDA, but they're investing for the future. So they've got a young fleet. They're opening up new offices every year. If I looked at cash profits, I'd have two very different. I might have the company that's deferring its capital expenditures would be throwing off a lot of cash. The guy's milking it for money, but he's not reinvesting in the company, and so he shows a high cash profit. And you would think that the high cash profit business is worth more than one that's investing all of its money into the future. It's the same size, but it's got no cash, at all. And so it's like, which is just because they each have 4 million in revenue and 1 million in EBITDA, one has high cash flow and it's not reinvesting. The other one has no cash flow because it's investing for growth. Well, we need a way to kind of neutralize, the way we can run a company that's generated to throw off cash to service our lifestyle, or we can be investing for the future to grow something that's big. And maybe I've got a lot of debt. Maybe I don't have a lot of debt. So cash profit does not tell the profit story of a company. Cash profit's a highly derivative. It's derived by how much debt do I have on it? Am I investing for the future? Am I growing or not? And so cash profit doesn't tell the story. And so we get up above the investment noise, and we get to this place called EBITDA. And at the EBITDA line, then that's a place where I can level the playing field, because when I buy the company, it's debt free. When I buy the company, it doesn't have to grow. Growth is always optional. And so I can just look at kind of like take revenue minus direct operating costs equals gross profit. And then I take out the SG&A costs and I start to hone in on my EBITDA line. And so this is a level playing field, because anytime I buy a company, it's going to be debt free. And anytime I buy a company, I can engineer how it's going to run. Whether I want to be a company that I'm milking for cash, it's my ATM, or it's a company I believe in its future and I'm really going to be investing to grow it. And so I'm not going to have a lot of cash profit. I'm going to keep constantly reinvesting cash. I need to find some kind of a level playing field to analyze companies that are being run differently, because how they're being run today doesn't necessarily dictate how I could run them in the future once I buy them. So EBITDA is like a level playing field.
That's a great answer. Hey, I don't have a lot more time, so I just want to get a little bit of current events. We got a couple political candidates out here. One of them says they're going to tax unrealized capital gains, which may affect private equity. Do you think that there's a trouble brewing with that, or do you think it will always turn out like it has in the past, which is the powerful create a carve out or a loophole and not affect?
Well, you would certainly like to think that in this country, the rich and powerful will always continue to find a way to get what they want.
They always do, man. They wrote options.
They
Remember
always
when?
do, right? They always do. I'm a capitalist. I believe in free markets. I don't believe in socialism. I don't believe in trying to control markets. And so, I tend to be, call it a conservative Republican. I'm a lifetime member of the NRA. I'm a Republican. It's like I think politics has become so polarized in the country. I wish we could get back to the days. I thought we used to be a divided country. Give me Ronald Reagan with Tip O'Neill, or give me Bill Clinton, with Newt Gingrich. Give me those combinations any day of the week when both sides used to be able to work together. I don't believe we can continue to let 20 million people, every 4 years into our country, and I don't believe, that we can sustain the type of spending that the federal government, they're drunk with spending.
$35 trillion.
Yeah, somewhere there needs to be fiscal control. Hey, you and I have to balance our checkbooks every month, and the government can spend and print and do whatever the hell it pleases. And I think we've become a society of free stuff. Whoever gives me the most free stuff, that's who I'll vote for, and that's a dangerous place. So I hope for the good of our country that we find the center again. We seem to be off on the ends. And we manage best when we manage in the center.
Adam, I'm almost out of time, and I want to say thank you for being on my show again. Everybody, this is a new release of the Private Equity Playbook. It's a different head because I don't have it from Amazon yet. But all of these books, the Exit Strategy Playbook and the Empire Builder, I do like this one the best. Thank you.
Yeah, that's my favorite too. But hey, thank you for having me on, John. And hello to all your listeners again. Good luck to you in your own empire builds. And hey, I'll see you again soon.
I hope so. Thank you.